e-commerce.
All right, and it's that time of the show, Biz Chat Weekly. Let's talk matters taxes, where Kenyans are set to see the introduction of new taxes as the government looks to increase its tax base and reduce its budget deficit. The new taxes include excess duty on money transfer transaction, digital service tax, and capital gains tax on shares and land sales. Jimmy Mbogo gives us a detailed story on this.
The Kenya Revenue Authority has set out to collect at least 20 billion shillings in 2023 through the capital gain tax, which was revised upwards in 2022 from 5% to 15% beginning this January. According to the KRA team lead for digital tax, Nixon Omondi, since 2019, the capital gain tax has contributed at least 21 billion, with the highest contribution coming in 2022 at 7 billion shillings, an avenue that the taxman is now seeking to exploit fully this year.
We expect to collect 3 times what we are collecting in 2022. So that takes us to about 20 billion. If you look at the rates of CGT in many countries, even 15% is still quite low. Our neighbors, Uganda, charge 30%. So if you look at 15%, there's a big difference. Yeah. Very favorable. And of course, in the spirit of having East Africa community, then rates should also be almost at par. And lastly, maybe but not least, is the government also wants to raise revenue for the betterment of our country. And you know, taxes are plowed back into the economy.
At the same time, he has demystified the misconception that the digital tax service will increase the cost of items in the country, arguing that the tax is levied on vendors who are based outside the country and not the consumer or the product they purchase online.
Digital service tax is a tax on the seller, not the buyer. So, Jimmy, if you're buying your nice mobile phone or iPhone 14 Pro Max from Amazon, there's no digital service tax because you shall have been charged the VAT and all the attendant taxes upon entry at the port of entry. So, digital service tax is about digital services and is only accounted for by non-residents.
However, even as the government pushes for CGT compliance, Kenyans have been urged to know the areas eligible for CGT to avoid being conned. The areas include transactions such as land with a value of 3 million shillings and above, while shares not traded at the NSC have no threshold, meaning all shares transferred are eligible for CGT. There are also tax exemptions from CGT.
There are many other exemptions, especially for land and also for shares. You see, for shares, the law allows for, if you are doing an internal transfer, then you are also exempt because it might be within the same group, but you are just transferring those shares from one company to another. Okay. Of course, we do a lot of due diligence. Currently, we handle a number of those cases where we want to ensure that people don't use such exemptions to evade or avoid the capital gains tax. When you come to land, there are exemptions. For example, if you are transferring to your children, the law uses immediate family members. That's actually your children. You are not subject to any capital gains tax. And that again also dispels the notion of gifting. So if you are giving to your spouse, or if you are doing it as a divorce settlement, there's no capital gains tax. Because if you look at it by and large, you are simply moving the item from your left to the right.
Jimmy Mbogo, KTN News, Nairobi.
All right, so there we have it. Matters taxation. Ken, 2.14 trillion. That's the figure that we always have to keep in mind. And the government is very particular on this. In terms of funding your budget, this strategy of minting, and making sure that taxation is a major tool of it, how do you interpret it?
Many thanks, Noah. Indeed, the 2.14 target is, to many people, appears to be an ambitious target. But when you look at it from a relative perspective, this is an economy of about 12 trillion shillings. So that's only about 17%, about 20% of GDP. That's very low compared to South Africa, which does about 40% of its budget to GDP. If you look at the UAE, it's about 32%, UK 50%. So Kenya in as much as we think of 2.14 as very aggressive, is actually very reasonable in of its sense. So that's point one. I think the only challenge is how the government will go about collecting it. And it seems they'll be very heavy on what we call consumption taxes, VAT, excise tax. The challenge with those is they tend to hurt the people at the bottom the most. They make the cost of living higher for people at the bottom, and they disproportionately hurt people at the bottom. So I think the target is okay. In fact, I think the target can even be more aggressive, but I think how we are planning on achieving it, if you are going to use the VATs and the excise tax, you'll end up hurting the people at the bottom, which is contradicting the whole bottom-up economic model, which is supposed to really benefit the person at the very bottom.
But one of the promises that this government came into power with was taxing the wealthy, which is also another avenue, taxing wealth. Looking at CGT, capital gains tax, is it another way of just looking at the players in the game on matters capital gains? Is it a way of taxing the wealthy, or how do you interpret that?
Well, if you look at the Kenya Kwanza manifesto, they talked about moving Kenya from regressive taxes towards progressive taxes. These are tax policies that are anchored to your taxable income, your wealth. So CGT is, in their mind, an example of this. The only problem with capital gains, okay, let's look at the philosophy that's underlying capital gains. It's saying that your land has appreciated in value, so it's only fair that the state is able to recoup some of that appreciation, which is a fantastic idea. The problem is that's what land rates already were designed to do, and any landowner today is paying land rates every year. So the big problem is you're going to subject people to some sort of double taxation, where somebody who's been paying land rates, because land rates were designed to target the appreciation on land and return back to the states, to the state. Now you're adding CGT to them, so you end up now you're almost double taxing people, which is not the avenue that we should be going.
And the virtual space also, we've seen digital service tax, the Googles now, the Netflixes that we've been consuming are going a little bit higher. And this was the discussion earlier on. Majority of these companies that extract value from the country, but are they paying something? That is one. But two, also that cost it trickles down to the consumers. So the balance between that, how do you see that?
When it's very true that those companies need to be paying their fair share, but the way companies should be paying their taxes should be through their corporation tax and the income tax of their employees. When you add VAT to their services, it's not really those companies paying. What they'll do is they'll push it to the consumers. So the person you're really hurting is the consumer, who will have to pay higher. And what will often happens is people will say, maybe I don't need this service after all. It's become too expensive. So that transaction that was there in the beginning disappears, and the little tax that the government would have collected at the beginning now disappears because people look for cheaper alternatives. So the right way, and that's why we talk about progressive tax policies. Progressive tax policies are like corporation tax, about income tax. If you want those Netflixes to be paying their fair share, it should be coming from their corporation taxes. It should not be on VAT, because VAT will just be slapped on the users, many of whom will just move away and look for cheaper sources of entertainment.
Definitely. And you've talked about progressive tax policies, and we're being told we don't have a tax policy yet as a country, but we've been told those stages are almost coming to something concrete. Talk to us about what impact a tax policy would have for the local economy and taxation regime.
I think the most important feature of a tax policy is ensures there's a level of justice and proportionality. Justice is the most important thing. Tax is an act of justice. And what a tax policy should ensure is anytime a new tax is introduced, people should ask, is this a just tax or is this an unjust tax? That's number one. Yes, you are right. The government, towards the previous government, towards the tail end of its reign, tried to come up with a tax policy where they put a predictability as an important thing. But I think that's number two. Predictability, convenience should be number two. But it should be a just tax at the very beginning. And you can only have a just tax if it's proportional to people's ability to pay. So there's no way that somebody who's jobless today on the streets is paying the same rate as a CEO of a multinational company. And that is where the progressivity comes, that your tax rate should be able to be proportional to your level of income. I mean, there's an element of, as people say, to whom much is given, much is expected.
Definitely. And talking about justice, I mean, looking at the economic projections for this year, an expected global recession, all these constraints that we are seeing, and the drive to collect more. How do you balance the two when you're experiencing a business downturn and a revenue collection upturn?
Well, it's important that they continue raising the revenue because, as I said, if you look at our revenue to GDP, it's very low compared to other countries. So there's clearly a lot of money there that is not going back to the government. So it's important, and it's good that they're using technology to use it. What I'm worried about is a 300 billion shillings cut because their strategy is to reduce the deficit. So raise revenue and reduce expenditure. The problem when you start putting in austerity measures, government spending goes down. So maybe what government was spending to hotels or to the media or to other sectors goes down. And that has a ripple effect in the economy to suppliers. For example, let's say if you're a roads contractor, you did a bit of job, maybe you borrowed from a bank, then the government takes time to pay you. It sort of complicates your business. So I think that part of austerity measures need to be relooked. I think the government should focus on increasing revenue collection, but really allowing the budget to remain as it is. Otherwise, if you have too much tightening, remember the central bank is also tightening, it's raising interest rates. The IMF is focusing the global economy to slow down into a recession. That's already 3 areas of tightening. So you don't want to push our economy further into a slowdown.
Yeah, definitely. You've used a lot of tightening, and I'm tempted to say, in 2023, I'm a very optimistic person. I hope things will work out and we have a ton of events. But I think personally, as an individual, briefly, Ken, in less than 30 seconds, how do you prepare for all this avalanche of news or global recession or taxes as an individual and matters personal finance? How do you handle that?
I think the key word is resourcefulness. I think what people are realizing during recessions or slowdowns, people realize that there are many things that they are not utilizing that they could utilize, whether from a personal perspective or a business perspective, or even from a family perspective, that could earn revenue. So I think it's a time for innovation and resourcefulness.
Definitely. Innovation and resourcefulness. Yeah. What a way to finish Biz Chat. The first one. Do you already have quotes? Innovation and resourcefulness. Ken Gishinga, okay? Give credit where it's due. Thank you very much, Ken, for that engagement. We take a short break right here on Business Today. We still have more to come. Stay tuned.